Good evening, everybody. Welcome to tonight's program. My name is David Matney with Nebraska Realty. And tonight I'm flying solo tonight, don't have a guest. And we're going to go over a couple of articles. I wanted to talk about the 50-year mortgage that was proposed by President Trump a couple weeks back. And I also wanted to talk a little bit about some foreclosure data and then some of the stats put out just this month about some of the home buyer characteristics. So with that, uh, just wanted to make sure, hopefully everybody can hear me okay. If you can, let me know in the chat. And then also in the comment section, um, I have a free valuation tool called HomeBot. So if you're a homeowner and you wanted to know the valuation of your property, then you can use this tool to find out the value of your home. So it's kind of a fun tool. It'll update you every week and that sort of thing. So hopefully you can get some value out of that and utilize that. And again, it's free. There's no obligation and that sort of thing. So, but with that, let's talk about if you can hear me okay in the chat. Oh, we already got a comment here. Let's see here. Let's take this down. Ben, how would you describe renting apartments in Omaha? Ben, that's a great question, and I work on the sales side, so I'm not as tuned in on the apartments side of the rental market, so I'm not a very good resource for that. But I can tell you this much: uh, there's a lot of apartments being built in the Omaha area. So um, sorry, I can't. If you wanted to contact me offline, we can go a little bit in a little more detail and that sort of thing. I'll give you my phone number there. You can call or text and that sort of thing. But I can kind of I do have a friend that's a property manager. She might be able to guide you into the right direction. So feel free to reach out or give me a call or that sort of thing later on, Ben. But thanks for the comment and the question. Great job. All right, let's go back to. And we have MH08. All right, sounds great. Okay, thanks MH08. Thanks for stopping by. It's always great fun to have you in the chat. All right, we're going to talk about the first article. Okay, and I wanted to talk about. We'll share this here, um, and that is you want to be careful about anytime you got to use critical thinking whenever you're looking at some of these articles because sometimes you can read an article or a headline and then you got to look at who's writing it and that sort of thing. But this first article is out of Newsweek and it says Trump's 50-year mortgages could be a big winner with millennials. Okay. And it goes on and it says that President Trump's proposal for a 50-year mortgage to make housing more affordable has raised eyebrows among industry observers, but new poll shows the idea could gain traction among America's younger prospective homeowners. Okay, now it says further on here, it says according to a recent survey of 1,000 Americans by a financial resource website, badcredit.org, okay, 45% of Americans say they would consider a 50-year mortgage if this became an option. And that, to me, that really scares me because number one, I don't know if you want to survey 1,000 people from the website badcredit.org. That to me, okay, that I kind of looked at that a little bit oddly. And then the other thing too I thought about, and that is, this idea, I don't think this article, and then I looked at the gentleman who wrote the article, okay, because I wanted more information about this author. Hugh Cameron is Newsweek's U.S. news reporter based in London. So this person is not even uh, based in the United States. And then the other thing I noticed is that he just graduated with a degree in politics in 2022. So I'm not sure if this person, I'm not throwing any shade his way, but I don't know if he necessarily even has a mortgage at this point. But I can tell you this, that really scares me in the fact that people are considering this. I'm going to be, uh, I think it's a horrible idea. Um, that, in my opinion, okay, and here's why. And then I'm going to bring up another article. And this is why it's really important that you got to use critical thinking when you're looking at things and be skeptical and, don't just take things at face value. Okay. This other article is from Inman and it says 8 reasons you should never recommend a 50-year mortgage. Okay. And again, I'm not giving you financial advice or anything like that. Let me share this tab instead. Okay. Um, and the first thing it talks about is the insane amount of additional interest paid to the lender. Okay, when you finance a property, the interest is front loaded. Okay, which means this, your first couple of years on a 30-year mortgage, very little is paid to principal. Most of that is paid toward interest. Okay, so I made a little chart here and I'll share this. Okay, and hopefully you can see that okay. I might try to make it a little bigger. Okay, but it's the 30-year mortgage, and we're looking at a loan amount of $300,000. Okay, and then we have a 50-year mortgage with a loan amount of $300,000. Okay, the interest rate, okay, because, and we're just kind of rounding things off here, at a 6% interest rate, when you do a 50-year mortgage, there's a little bit more risk involved for the lender, so they're going to charge you a little bit more money uh, to borrow that money. Okay, so your monthly payment for a 30-year mortgage for a $300,000 loan would be $1,798.65. On a 50-year mortgage at 6.5%, your payment would be $1,645.09. So the difference would be only $153 a month. So you're not saving that much money with a 50-year mortgage, but you got 20 more years of interest. Okay, now here's what I'm talking about. After 5 years, okay, your total amount paid would be $107,919. Okay, the amount you paid towards principal, which would be paying down that loan, would be $20,837. The amount of interest would be $87,082. So the vast majority of that went towards interest. Okay. So after 5 years, you would still owe $279,163. Okay. Now let's look at the 50-year mortgage. Okay. For a 50-year mortgage, your total amount paid would be $98,705. The amount you applied towards principal would be $6,329. And you would have paid $92,376 towards interest. Okay. Now, after 5 years, you would still owe $293,671 on that property. Okay. I wrote down here the 50-year mortgage is a wealth killer. And here's the thing, you're kind of renting both the house and the money. Okay, so with a 50-year mortgage, the reason why I think this is a bad idea is, when you rent, you're not responsible for maintenance. Okay, something goes wrong, you can call the landlord, and the landlord comes out and repairs it, hopefully. Okay, True, your rent can go up in those 5 years, but with when you own that property, guess what? If something goes wrong, then guess what? Um, you're responsible for that maintenance. So that's why I think on just the interest alone, it is a bad idea. Okay. And let's see, Ben says, I'm a current student at Lincoln Southeast Community College, but I'm also a military member with the National Guard. Ben, thank you for your service. My partner and I have been looking for houses to buy with my VA home loan. Thoughts? I think that's a great idea. Um, you have that VA eligibility, okay, and you also want to look at make sure you have money set aside in reserve, okay, and that sort of thing. But you're welcome to reach out and um, if you need a contact in Lincoln, if you're looking to, are you looking down in Lincoln for properties, or are you looking at Omaha? Um, okay, let's see. Active chat tonight. Hey, son of Joxer. Okay, I was paying off a 30-year mortgage. The interest payments were on par with the amount applied toward principal, which is basically treading water. A 50-year loan would be more like drowning. Absolutely, you are 100% right on that. It would be. You have all of the um, and I'm obviously I sell real estate for a living, so I'm a big proponent of home ownership. But there's pros and cons to buying a home, and a lot of things that gets overlooked is maintenance, and you're responsible for that maintenance. And then after 5 years, it would be even worse if you, let's say, after 2 years you had to move. And things happen, life happens. Not everybody is going to stay in their home for 30 years. Okay, most people don't because life is going to happen. But you're absolutely, I like that analogy because that is spot on as far as that goes. That's excellent. Okay. And then Jason says, we need tiny home communities. I would love to have a small shotgun house with a piece of land, but renting a lot in a tiny home community that offered amenities would be great as well. Um, I think they have to explore different uh, things like that because they have to have um, different ideas in order, because not everybody's going to be, and we'll dive into some of the stats hopefully tonight. We'll be able to dive into some of the stats put out by the National Association of Realtors in terms of what is the average age of buyers in the current environment. So yeah, that's uh, and we actually have a little tiny home community down near downtown in Omaha here. They put it up as a way to help the homeless. They put a little tiny community on there. They built one. I haven't been down there to see it, but it's these little houses are really really cool. So yeah, that's I agree with that. Yeah. Let's see here. MHO8 says I've been in this dump for over 34 years. Okay. All right. And Ben says Omaha, I'm transferring to UNO within the coming year. I'd like to establish my business in Omaha and have my vacation home here. I plan on moving to Oregon in 2035 or so. Yeah. And you got to look at your whole life situation and everything, Ben. So it sounds like you got a good plan on track there. So good for you. So awesome. So again, thank you for your service in the National Guard. All right. Um, we'll go back to this article here. So number one, you're paying an insane amount of interest to the lender. Okay, the second thing is let me share it. Sorry about that, guys and gals. Being in debt forever. The median first time home buyer today is 40. A 50-year mortgage means they will have payments until they're 90, provided they live that long. The only entity that wins here is the lender with their 50-year amortization table. Absolutely. Okay. Um, Monthly payment savings that go poof. Okay, you're really not saving that much money, like we said in that earlier example. Okay, uh, and you're paying a little bit higher interest rate because that lender is going to want more higher interest because there's more uh, risk involved. And then here's something that I'm not sure if a lot of people thought of, and that is 11 more years of private mortgage insurance, PMI. Okay. Um, when you get a loan and when you come in with less than 20% down, the lender is going to require private mortgage insurance. Okay. Now that insures the lender against the borrower defaulting. Okay. So what they're going to do is they're going to ask for a little bit higher, they're going to ask for a premium every month that's tacked on to your payment. So you have principal, interest, taxes, and insurance. And then if you come in with less than 20% down, you're coming in with private mortgage insurance. Okay. The only thing that goes towards your equity is the principal. All of that other stuff is uh, doesn't get applied to your principal balance. So that's just another reason why. Now, um, but yeah, that's I'm not sure a lot of folks have thought. I don't think this was, I mean, we all know President Trump. He's going to say things and do things without really. He'll put something out on Truth Social. Uh, he'll let it fly on Truth Social, float things around, but it's still something that would have to be. They'd have to change the laws in order to do that. But I don't know if this is really something that is going to gain a lot of traction because I think there's going to be a lot of pushback on it. Now, what would really help affordability is if interest rates came down a little bit. That helps affordability. And then the other thing too with here's the good news though, and that is at least affordability is being discussed. That's a positive sign because for a long time affordability wasn't really discussed. You would hear it on a real estate podcast because so many buyers are shut out of the marketplace, but at least it's now become something that it's being discussed. So, um, I think that's a positive aspect of it. But just because something's being discussed and just because an idea is proposed doesn't mean it's a good idea. Okay. Um, and then number 5, we talked about this, lenders front load interest payments. When you have a mortgage, whether it be a 30-year mortgage, 15 or a 50-year mortgage, you pay in the early stages of that loan, you pay more toward interest than you do principal. And at the tail end of the loan, when you're in years 28, 29, 30, those years, you're paying more towards principal. Your principal really gets, um, you know, uh, really gets, I don't know what the word I'm looking for, you start paying more toward principal. Okay. Massive opportunity cost. When the lender devours the borrower's income for an extra 20 years, that money could have been invested in a rental property, fractionalized real estate, or a REIT, real estate investment trust. That's what a REIT is, where it could be growing rather than paid out in interest to the bank. Exactly. I'm a big proponent of two things. Number one, if you can pay even just a little bit extra toward principal, I would do that. And then the other thing I'm a big proponent of, and that is when you get a raise, and my kids get so tired of hearing about this, but when you get a raise, um, invest that, don't increase your lifestyle, maintain that same level of lifestyle, only take that raise and then either pay down debt with it or invest it. Okay. Now, if you have a 7% mortgage interest rate, a good way to earn 7% without even thinking is to pay down the debt. I mean, if you invest, there's the chance of an investment going up or down. But if you apply it toward debt, whatever interest rate you're paying, that's a good way to earn an automatic, if you have a 7% interest rate, 7% on your money by paying down that debt. So I'm kind of a big proponent of that. Okay. Um, the retirement nightmare. Most Americans plan to retire debt free by 65 with a 50-year mortgage. They'll still be making mortgage payments through their 70s and well into their 80s, the very time when their income declines and healthcare costs increase. Okay. Uh, yeah, and you're seeing more and more retirees still working. And you got to think about somebody in my mid 50s. I am amazed at how fast time goes by. When you're in your 30s and 20s and 30s, 50s seem a long ways away, but guess what? It goes really quick. And before you know it, you're in your 50s. So um, you want to make sure that you start planning ahead. And if you want to pay yourself, and I'll say this about a mortgage too, and that is when you pay off your mortgage. Okay, if you apply a little bit extra toward principal, and then when you pay off your mortgage, and let's say your mortgage was just for shins and grins, let's just say it was $2,000 a month. When you pay off that mortgage, okay, or let's say you have a car payment, and let's say I don't know what a car payment is, but let's just say it's $500. When you pay off that car payment, still make that payment. I mean, you pay off your car, okay, but still make that payment. But instead of applying that $500 into, giving it to the bank or the car company, put that into a savings account or an investment account. Still make that $500 payment. Or if, let's say your mortgage was $2,000, still make that mortgage payment, but instead of applying it to you know your uh, your house payment, put that payment toward your investment account or apply it to other debt, things like that. I had a couple rental properties, and that's what I would do. When I would pay off one rental, I would take that payment and apply it to the next rental. So kind of like that Dave Ramsey type of thing. So let's see. MH08 says time is like a roll of toilet paper. It goes faster as you get towards the end. Absolutely, 100%. I completely agree with that. Uh, you are absolutely 100% right about that. All right. Um, let's see the psychological and life track. 50 years of payments crush mobility, making it harder for borrowers to relocate for jobs and family needs, and adding to the mental weight of carrying 50 years of debt. Exactly. Um, that's one good thing about renting is you do have that ability to up and leave. Um, and when you're younger, sometimes you don't know where you're going to land. It may not be home ownership isn't for everybody. So anyway, those are. I don't know if they. My thought process is if in order to um, buy a home, you have to use the 50-year mortgage, then I would say you shouldn't be buying a home. It's kind of like folks that say, they want to buy a home, but they're like, well, I can't really afford to do the home inspection. Then you shouldn't be buying a home if you can't afford to do the home inspection. Okay, that's just my opinion on that. But uh, wanted to talk about that 50-year mortgage just because it's been going out there. A lot of ideas are being thrown about now. Whether or not they will gain any traction or not are going to be two different things. So, but that's the article I wanted to talk about um, with. Now, the other thing I want to talk about is let's put this on here foreclosures. Okay, there's a lot of news right now going around. This article is from CBS News, and it talks about foreclosures are surging as U.S. homeowners grapple with rising costs. Okay, and that's true. You got states like Florida where it's not just uh, the mortgage that's costing them a lot of money. Some of it is in the insurance and some of the HOA requirements and the special assessments and things like that. So foreclosures are surging, but that sounds like a really scary article. Okay. Um, Kimberly Draxler was in shock when she called her mortgage lender in April and was told her 4-bedroom home in Hillview, Kentucky would be sold out from under her in the matter of days. Okay. Even though she had been alerted that something might be wrong with the letter in a mail from her attorney offering assistance in warding off foreclosure, she said her lender never informed her that she was about to lose her home. And it's terrible that folks are losing their home. That's no doubt about that. Okay. Um, but it sounds like, okay, here you got an article saying foreclosures are surging. Okay, that sounds really, really bad. Okay, and that they're, you know, foreclosures are up. And then if you go to YouTube, YouTube gets a hold of this. All right. And then what I did was I ran it through filters and I said, okay, go for view count and let's go within the past week. Okay. And what shows up on YouTube? Oh my gosh, evictions are coming. People will go insane as they lose their homes this winter. And then look at this, wow, it's even look at the dark, scary background. I mean, that's, mass evictions. There's going to be folks that are up, hey, yeah, that's, and then you got Meet Kevin, foreclosure crash is starting, housing reset. And then he has a new link to a news article there. Um, Market meltdown as foreclosure surprise hits Wall Street. Okay. That's the economic ninja. Then there's some shorts, the crash of the century. Wow. All of these really scary articles. Okay. And I get it. Here's the thing, too. I agree. The dark, stormy skies in the background was a really nice touch. I, 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 I had to agree that was really some great editing on that. That's we won't play it because then I might get a copyright strike. But yeah, he had uh, uh, some dark, scary clouds and stormy skies. That was really scary. Okay, but you have you and that's just the thing with YouTube, and I'm guilty of it too. Where you're trying to get people to win the click with the title and things like that. Bad news sells. Okay. But I wanted to pull up this article from Housing Wire, okay, and it talks about a growing foreclosure crisis, not according to the latest data, Fed data, okay, and this is written by Logan Motoshami. So we had somebody that just got out of college based in London talking about the 50-year mortgage. Logan is somebody that I follow, that I trust, that puts out solid data and that sort of thing. So you got to kind of watch your news sources because not all articles are created equal. Okay. And they're talking about the foreclosures. Okay. And how they have, but I wanted to bring up this graph. Okay. Now you have foreclosures in dark red, and then you have bankruptcies in the pink. Okay, so we're going to just look at the foreclosure data. Okay, now this was 07, 08. This was the great financial crisis. Okay, that was a whole different animal. Okay, we had a lot of inventory. There was a lot of foreclosures, a lot of short sales, that sort of thing. And then as we came out in 2012, 2013, you can see the number of foreclosures going down, going down. Then you had 2017, 2018, 2019, 2020. Okay. Then what happened? We had the pandemic. All right. And then what happened to foreclosures? Wow, they just went down to nothing. Okay. But what happened? Okay. Then and foreclosures increased. Okay. They increased over the pandemic because they had that moratorium on foreclosures. But then since then, they have increased. But something, a foreclosure going up 32%, or 20% year over year is not that big a deal compared to, um, pre-pandemic. Okay, nobody was talking about a foreclosure crisis, when we actually had more foreclosures in 2018. That there's always going to be folks that, for whatever reasons, people hit hard times and things happen, and they're going to, uh, but bad news sells. So I wanted to just caution you about, when you hear articles and headlines and videos about the foreclosure crisis, and there is a whole bunch of folks out there, and they have a lot more subscribers than I do, and they put out bad news and scary articles and scary videos about all the upcoming foreclosures and things like that, and how that's going to crash the housing market. Housing market data should not be that exciting. Okay, it's become this kind of like little cottage industry where putting out all those videos and everything because people glom onto it. But before YouTube, there wasn't everybody talking about. People still love talking about the housing market and stuff, but some of these are just kind of nerdy numbers that nerds like myself glom onto and get all excited about. But most times it's not. But as you can see, this down here is nothing like this right here. This is 2008, that we had a whole different environment then than we do now. So um, our homes, is it tougher to buy a home now? Absolutely. But um, here's the thing too. It's just like and I put out a video and I put out data, and then people will just say, "Oh my gosh, you don't know what you're talking about. The housing market is going to crash." And I'm like, "Oh, good grief!" But what I'm trying to say is, you got to use a little critical thinking when you're looking at some of these articles. All right, and be careful. And it's also, this is another graph here where they talk about negative equity. Okay, now look at the folks in 2013. These were the folks with 12% of the homes had negative equity. Okay, look at negative equity now. Okay, let's try to find it. Okay, the folks with negative equity. Okay, 1.43% of the homes are underwater. And that's because for the past 5 years, prices just went way up. So guess what? There's not a whole bunch of buyers out there that are, homeowners out there that are, have negative equity. Okay. That's so, I just want to kind of put that out there because I see these articles and I see these videos, and I'm like, they talk about all, forced selling and all this sort of thing. And it's like, slow down on that, because there's not that many buyers or homeowners out there that have negative equity. Speaking of homeowners, I want to share something with you guys. That I might have already shared this with you, and that is my thing called HomeBot. Okay, you can get the value of your home. Okay, and I'll drop a link to it in the chat. I think I posted it earlier, but you can get the valuation of your home, and it'll send you a monthly update and that sort of thing. So hey, check it out. It's kind of cool. And then the other thing I have, I'm trying to promote. Okay, is if you go to my website, livinginomaha.com, then you can join my newsletter. So put your email in there, and I'll send you a monthly email about Omaha and that sort of thing. So anyway, I'm trying to promote that a little bit. Livinginomaha.com. So put that in the banner there. Okay. But anyway, there's not this growing, all of these foreclosures and negative equity, all the scary things you hear about, in terms of that. And then also let's talk about this here, uh, the people that are buying homes in terms of their credit score. Okay. Look at the folks in terms of the majority of FICO score data for 15 years have been 720 and above. So there's very few folks out there, okay, that are coming in with those low credit scores. Now they're trying to change that, okay, where they're going to erase the credit scores, and that has a lot of folks in kind of a kerfluffle. But they're also going to have other qualifying things, like they have to have, higher down payment and things like that. So it won't be as many. I don't think it'll be a repeat of, back when I started selling real estate. This was 2003, where if you fogged a mirror, you could get a loan. Those days are done. So that's why we had the foreclosure crisis, is because when I started selling real estate, okay, I started in 2003. And in those years, it was very rare to do a FHA loan. There was very few folks that you would do an FHA loan. It was kind of rare. And then because they were doing, um, you know, 100% financing. And when now you have to actually have a job and qualify. But back then, before the great financial crisis, if you fogged a mirror, you could get a home, and that didn't work out so well. So there's been some concerns out there about, okay, if they change the credit score requirement, that could lead to another 2008. But I was here listening to another lender today, and he said that's not going to be the case, in terms of just they're not going to be willy-nilly, uh, uh, fog a mirror and get a loan. And then this is mortgage rate breakdown. 70.4% of mortgage borrowers have rates at 5% or below. Okay. And then this graph here shows the folks that are above 6%. Okay. These are the folks that are 5 to 6%, the number of mortgages. The blue is 4 to 5, and look at the red. 20% of the mortgages out there have below 3% mortgage interest rate. So that's folks, and prices went up, and people are sitting, and some of them are locked in and that sort of thing. So um, his conclusion: overall, the housing credit market is not showing significant stress despite the ongoing hype surrounding FHA loans. The bulk of the loans are currently trending below stress levels seen earlier in the century, much less during the great financial crisis. When we exclude 40% of the homes in the US that do not even have a mortgage, we find that most homeowners with a mortgage hold a 30-year fixed rate loan. These homeowners typically have substantial equity and reliable long-term payments, which isn't a point often emphasized by those who predict doom for the housing market each year. Okay. And again, some of these folks have been predicting doom for the last 5 years, and every year. Then when it doesn't materialize, when the crash doesn't materialize, then they blame um, housing market manipulation. So everybody's manipulating the data. So that's my little rant on that. But uh, anyway, that's from Housing Wire, and that's talking about the growing foreclosure crisis. Wanted to talk about that article. And then what thought we would do is I'm going to bring up the MLS, and then what I thought we would do is look at Douglas and Sarpy County, okay, and then how many real estate owned or foreclosures are there in Douglas and Sarpy County? Okay. And when I say all active, okay, um, when you all active, there's only 8 real estate owned or bank owned properties, okay, in Douglas and Sarpy County. And then when we pull those up, this is what we're looking at. Now we got a wide variety of ranges here. We have something down in the $90,000 up to $529,000, but we'll take a quick peek here. 3911 Gertrude Terrace. And sometimes these can be pretty rough on the inside. Yeah, that house has seen better days. But again, it's only $90,000. And again, with a foreclosure like this, it'll be as is, and the seller's not going to make any repairs. And it's probably going to be either in terms of financing, check that here. It may be cash only, so they're not even letting you finance it. So that's cash only. Here's another one, a bank-owned property, 3-bedroom, 3-bath, $125,000. Let's take a look at this one here. And then let's see what the financing on it is. This one's conventional or cash, but long story short, there's not a giant slew of bank-owned properties in our MLS. So just so you're aware of that. And then the other thing too, there's HUD Home Store is now during the, I'll share this with you. There's HUDhomestore.gov, okay, and this is for HUD homes, okay, and then in Nebraska there's one property. Now back in the day in 2008, there would be a lot of homes on here. There'd be it's been years. It's probably been 12 years since I did a HUD foreclosure. But in Nebraska, there's one property. Okay. California, there's 73. These are some of the big states with all the foreclosures. Florida is 65. Iowa has 11. Okay. And then Illinois has 31. Those are some of the states with South Carolina, I think, has, I'm not sure what one of the, I looked at an article earlier, but those are HUDhomestore.gov. But again, there's not a lot of properties out there on that in terms of HUD foreclosures. Okay. Now, the other thing I wanted to share with you guys is let me find it here. Okay, here we go. All right, I wanted to share this here. This is the 2008 or 2008. I got 2000. The 2025 profile of home buyers and sellers, and just wanted to share some stuff out of this here because I think it's pretty cool here. Okay, this is characteristics of the median age of home buyers, and this is going back to 1981 to 2025. Okay, right here in yellow is all buyers. For all buyers, the median age was 59. For first-time home buyers in blue, it is at an all-time high of 40. Okay, And then for repeat buyers, okay, the median age is 62. Okay, median means half the buyers, if you had 100 buyers, 50 of those were above 62 and 50 were below 62. So this is at an all-time high of 40 years old. Look back in 1981, okay? The first-time home buyer back in the day in 1981 was 29 years old for a first-time home buyer. For all buyers, it was 31. And then for repeat buyers, it was 36. So look at how that chart has just continued to go up. And now that we see in 2020, it went up. In 2020, this was 2021, when those interest rates went up, look what happened. That age shot up. Okay. But for a long time, it was kind of chugging along in their 30s. Okay. But then what happened was those interest rates went up. And here's the thing with this unaffordability thing, and it's frustrating because, but what happened had to happen because we had to slow down. We had to stop that runaway freight train with prices going up. We didn't have enough homes, and when you have high demand, when you have interest rates so low and everything was so affordable because interest rates were below 3%, then that creates demand. Okay. And when you have high demand and low supply, what happens to the price? So, what they had to do in order to um, slow down price growth is they had to raise those interest rates in order to decrease demand. And that's why when you do things like a 50-year mortgage, that's working on the wrong side of the curve. That's working on the demand side. You want to work on the supply side. You want to add more supply. If you really want to lower home prices, you have a robust economy and you have lots of supply, and then prices will come down. But right now, what we have to do is, unfortunately, right now, sales are depressed because and people are still out there buying. Okay, people are still out there buying, but it's just older folks that are buying the homes. That's who's out there buying the homes. But this is shocking to me. And then when I look at the demographics on my YouTube channel, I will see that the people watching my channel are tend to be older folks. I mean, I don't have a lot of 18-year-olds watching my channel. So um, that's that's the median age of the home buyer. I wanted to share that with you guys. And then this is, again, the age of the first-time home buyer and repeat buyers. And then it gives it a breakdown by percent. Like, out of first-time home buyers, only 4% were between 18 and 24. Okay. 32% were between 25 and 34. And then the median age was 40. Okay. And then for repeat buyers, okay, the median age was 62. And then it gives it a breakdown of, okay, 30% of repeat buyers were between 65 and 74. And this is all buyers right here. Okay, that's all buyers. So, and then it also gives a breakdown of married couples, single male, age-wise. So, single female, 44, married couple, a little bit younger, 39, single male, 39. And then this is the adult composition of home buyers and households from 81 to 2025. Okay, back in 1981, 73% were married couples. Okay, only 11% were females, single females, and 10% were single males, and then 6% were unmarried couples, and then this green line is other. Okay, um, back in 1981. Then look at it 2025. All right, married couples is down to 61%. Okay, so we went from 73% down to 61%. Look at the yellow, single females. Um, Back in 1981, it was 11%. Now, 21% of buyers are single females, and then 9% are single males, and 6% were unmarried couples. Okay, so uh, I just think that's kind of fascinating to look at these numbers and these demographics and things like that. Um, Adult composition of first-time home buyer households. So 50% of first-time home buyers are married couples. 25% are single females, and then single males are at 11%, and then, or excuse me, unmarried couples are 11%. And we've seen that number has increased. And then unmarried couple or single males are at 10. Okay. And then this is fascinating to, in terms of number of children under the age of 18 residing in a household. Okay. Um, and this is of buyers. So 76% of buyers had no kids. 11% had one, and 9% had two, and then 5% had three or more. And that might just simply be because of all of the other costs involved. It shocks me when I hear people talk about the cost of daycare, how much daycare is. Um, it makes me think, man, if kids didn't drive me crazy, that'd be a good bit, good business. But I don't know. You know, my kids are grown, but I don't know about that. But the cost of childcare and the cost of everything is so high. It's squeezing. And here's the other thing too. It makes sense because people in their 40s and 50s, those kids are grown. So this makes sense that they wouldn't have any kids at home. Okay. Um, Share of home buyers with children under the age of 18. Okay. This is kind of a weird how it little does this little thing here. Okay. But this is no children in the home, and this is the blue line, children under the age of 18 in the home. So we went from 41% back in 1981. Now 24% of buyers have kids under the age of 18 at home, whereas 76% of home buyers have no children in the home. And again, that makes sense when you look at the age of the demographics of the buyers, of who the ages of buyers. So I just think that's amazing how you look at this graph and it just keeps going up. And then if you look at this one, it's trending downward. So, and then this is how many homes were purchased. This was for all buyers, were multi-generational. So you're starting to see an increase. 14% was a multi-generational household. I think that's going to be increasing. And then I think this was interesting too. The reasons for purchase. Okay. Health, caretaking of aging parents. 41% of buyers, that was their reason for purchasing. Okay. Cost savings. Um, Children, relatives moving back into the house, 27%. There's probably more of that. Children under the age of 18 residing in the home. You're going to see healthcare that's driving a lot of things, taking care of aging parents. So there's a lot of folks that are in that age group. Okay, and that makes sense. If people are in their 40s, you're gonna see more of that in that age group. But I think that's kind of um, fascinating. Okay. Characteristic of home buyers: highest education achieved uh, by household. 6% had a doctoral degree. 25%, 26% had a master's degree, and then 19% had a high school graduate. It's kind of fascinating. They get this data. Um, Self or spouse or partner is an active military or veteran. Um, 18% were veterans, and then neither person serving was 81%, and then only 1% was active duty. That makes sense because you're being stationed in different spots and stuff like that. So this I think is fascinating. Okay, look at this. Characteristics of home buyers. First-time home buyers from 1981 to 2025. This is the percentage of home buyers that were first-time home buyers. In 2025, only 21% of the buyers in the marketplace were first-time home buyers. Okay. Look back in 1981, it was 44%. Okay. Look at as we came out of the great financial crisis. Okay. Remember they had that first time home buyer credit, that $8,000. And look what that did. That was 50%, close to 50% of the buyers were first time home buyers when they had that credit back then. Okay. And then as you can see, um, it's gone down since then, but this is last year it was 24%, and that was an all-time low. And then this year was even worse. It was 21%. But I have a theory on this. Let me know what you think about this in the chat. I think some of these older buyers are buying homes for their kids, is kind of where I'm thinking some of the first time buyers are being displaced. I think it's mom and dad buying homes for their kids. I know a couple folks that are doing that where they're just buying them for their kids, just because the kids are priced out of the market. So I think it's the mom and dad. I don't think, and this might anger some folks, I don't see all of these institutional investors. Are there build to rent communities? Yes, there are. There's build to rent communities out there, and you have private equity buying a build to rent community. But I don't think it's as prevalent as people make it out to be. Okay, I don't think there's this vast array of institutional investors clamoring to own a single family home and I know when some people think it's in different parts of the country and that sort of thing, but I really don't think if you've owned rental property before and how much of a pain in the butt some of the and it's not as lucrative as when people talk about rental property, people make it out to be a lot more sexier than what it actually is. It's not as lucrative as people make it out to be. Okay. And it's a lot more. And when everybody says it's passive income, that's for the birds, because it's not passive income. It's a lot of work. But there's a lot of, and then the other thing too, when you really look at it, if you look at like the paint remediation and repair regulations that the EPA installed in 2011 for homes built before 1978, you're not having BlackRock coming in and buying up an old home built in the 1960s, and they would have to follow all of those regulations. And they're not going to do it, because if they didn't do it, somebody would just sue the daylights out of them. But I don't think there's this big contingent of private equity. Now, private equity is in a lot of stuff. I'm not going to doubt that. And I'm not this big fan of private equity. But I don't think there's this vast majority of buyers out there that are being displaced because of private equity. I really don't think so. I think what it is just probably what should have happened, okay, was when inflation was transitory. Remember when inflation was supposedly transitory? They probably needed, the Federal Reserve was late to the game, and they should have raised rates sooner and slowed that down, that train down sooner rather than what they did. But we had to raise rates in order to, and unfortunately, I think the only way to fix all of this affordability is not, helicopter money and stimulus checks and things like that. Is I think it's going to take time, and I also think it's going to take good policy. I don't think, and I'm going to go, I'm going to say some things political here, I guess. I don't think tariffs are a good thing. I think fair trade is a good thing, but I don't think necessarily tariffs is a good policy where you increase some of the prices, because that's a tax on the consumer. Is when you raise the price of something, that's a tax on the consumer. So hopefully, and you're already starting to see it, where President Trump is rolling back some of his tariffs on certain products. Like I seen that today in coffee and things like that. So I think some of this is just simply going to take time. Okay. But here's the deal with the housing market. It's always changing. There's always opportunity out there. It's going to take time. I don't think a person should panic. I think what they should do is plan. You got to plan more. It's going to take, and that's why you have, folks in their, late 40s and 50s, have had the ability to save more. So unfortunately, this has got to correct itself, but it's going to take time on that. So that's kind of my thought process on that. But feel free to disagree or let me know in the chat, that sort of thing. But hopefully that doesn't irritate too many folks. Let's talk about income. Let's on this one here, household income of first-time and repeat buyers. Okay, the median income for a first-time home buyer was in $94,400. Okay, for repeat buyers. Okay, and remember those repeat buyers were the ones that were 62 and above. The median age was 62, was $111,700. And for all buyers, it was $109,000. So unfortunately, that's not going to, you're not going to, people are priced out of the market, so that's kind of that. But anyway, I don't know if you guys thought that was interesting. I don't know if there's anybody still in the chat or anything, but hopefully you found something interesting about it. But that's kind of it for tonight. Let me see if there's anything else. Anyway, I wanted to share that. I'm going to put that in some of my videos and stuff, because I think I'm fascinated by some of the stats and stuff like that. But I wanted to talk about the 50-year mortgage and the foreclosure data and things like that. But anyway, if you have any other questions before we go, let me know in the chat, and then we'll see you guys next week. And again, thanks again. Bye-bye.